All right, welcome to the Money Multiplier, Infinite Banking, how to become the bank, how to become your own banker. Just like the hat says, be your own banker, BYOB. And that's what this training is all about this evening. So thanks for joining me. My name's Stephen Nagy. I'll be taking you on this journey here this evening, and I'll tell you a little bit more about myself as we get rolling through this thing. But I learned about infinite banking a little over, I guess, about 3 years ago now. I've implemented it into my life, and I was a financial advisor, a licensed financial advisor out of college, and have been in the investment, got into real estate investing. I've owned several businesses, have coached and trained clients and students all across the country in all 50 states on financial education, and reside in South Florida with my wife and son I've been back down in South Florida for the last, I don't know, 12 years now. And this is home. So over the years, I really studied a lot about investing and moving money and finances, and have worked with a lot of clients, from people that are millions of dollars in debt that are looking to get out of it, to people that have millions of dollars put away and are looking to make more and protect it and make sure it's safe. And so I've had a lot of experience working with a lot of different types of clients over the years, and now use that today to share different financial strategies. And what I'm teaching you here tonight is one of the most powerful financial strategies and tools that I've ever seen before, because what we're able to do with the infinite banking concept is basically set our finances up to create a perpetual tailwind on all the money that we have and all the money that we earn. And instead of giving away interest and giving away money to everybody else that bleeds it out of us, and instead of paying taxes and dealing with inflation and volatility, we're able to use this as a way to not work any harder, not work any longer, not take on any more risk, and achieve the financial goals that we want to achieve in life. So that's what I'm going to be sharing with you here tonight. So any questions that you have, put them in the Q&A box. I'll be sure to answer those as we roll, and we'll have a good time as we go here. So I'm going to talk a lot about money and opportunity. So like I said, we teach a lot of different financial strategies. We talk about a lot about real estate investing, private money lending. We get into some other topics, and there's going to be a lot of opportunities coming up. The stock market right now is on a trajectory downwards. We're in a bear market, recession, whatever you want to call it. And it's going to create a lot of opportunities, because we're going to see a lot of harder times coming up before we see good times again. And so there's going to be a lot of opportunities. So right now is a really good time to start understanding where your money is, what your money's doing for you. How can you prepare for the opportunity that's ahead? And money at the end of the day is not a mystery. Money is not something that we need to be scared of. Money's not something that we need to be intimidated by. Money is something that if we can understand how to keep it moving, if we can understand where our money is right now and how to take advantage of laws and rules and opportunities that we have here in this country, in the United States of America, then we're able to use money to create a lifestyle for ourselves, to create, to achieve your goals, whatever those might be. Because if I was to ask everybody on here right now, what does money mean to you? What is financial freedom mean to you? What does retirement mean to you? What do financial goals mean to you? Everybody would have different answers, right? Some people want to be able to fly around on private jets and drive the Lamborghini and have the fifth wife that's a model, and or whatever, right? And other people just want to be able to enjoy life and maybe travel here and there, and just not have the stress over where's the money coming from. So everybody's a little bit different. So what I want you to think about tonight is, what are your goals? What are your dreams? What does financial freedom mean to you? And then we're going to create that plan. We're going to create that strategy to get there. And one of the things that's really helped me over the years achieve financial freedom and achieve reaching my goals and take advantage of opportunities are various mentors and coaches that I've had along the years. And so I just wanted to kind of highlight a couple of those coaches right now. So Brent Kessler is the owner and founder of the Money Multiplier. A lot of what I'm teaching you here tonight has come from Brent. And Brent didn't invent what I'm teaching you here tonight. I didn't invent what I'm teaching you here tonight. It's been around for over 200 years. There's somebody by the name of R. Nelson Nash that about 30 years ago started bringing it to the mainstream, but this is nothing that we've invented. It's been around for over 200 years and it's been used consistently in this country. But Brent brought it to my attention and taught me a lot of what I know. So you guys got to check out the moneymultiplier.com. And if you don't know Brent yet, I'm sure you'll get to know him. And then another guy, if you're here tonight, you probably know Chris Noggle. Chris Noggle is not only one of my mentors and coaches and has taught me a lot about moving money and about the infinite banking concept. But Chris is also, a business partner, and we work together hand in hand in a lot of the stuff that we do. So chrisnoggle.com. Now, Chris is out traveling tomorrow. So our weekly webinars that we usually do on Wednesdays, he will not be there for them tomorrow, but the show must go on. So I'll be there tomorrow morning with Larry Steinhaus for What the F Happened in the morning. And then tomorrow afternoon at 1 Eastern, I'll be conducting a training on private money lending in the Private Money Club. And I'm going to have several people coming on throughout Wealth webinar tomorrow to say hello, and I wanted to introduce you to them. So make sure you join us tomorrow for that one. So the show will go on when Chris is out traveling in California and Vegas. I'm here in the office getting things done. And Chris is an unbelievable guy. So you guys will get to know him as time goes by as well. And Chris introduced me to this quote right here. It's now one of my favorite quotes. The problem in America isn't so much what people don't know. It's what people think they know that just ain't so. What I mean by that is I'm going to teach you a lot of techniques tonight that might be new for you. Again, this stuff's been around for a long time. It's proven, it's guaranteed, but it might be new for you. And one of the challenges I found over the years when it comes to introducing somebody to a new subject is they think they already know everything, or they think, hey, I've never heard this before, so it must be a scam, or it must be fake, or it must not actually work. There must be some kind of gimmick to it, right? And so a lot of times, like, our own minds will hold us back from new opportunities. So I just want you to keep this quote in mind as we go here tonight, because a lot of what I teach you is going to be stuff that is used by the 5% of this country. But unfortunately, the other 95% of Americans don't either have the drive, they don't have the wherewithal, they don't have the mindset, or whatever it is to allow them to take advantage of stuff like this. And because they're holding themselves back, or they're blaming everybody else for their problems, or excuses of why they aren't more successful, it holds them back. And the Social Security Administration tells us if you take 100 Americans, only 5 out of 100 people at retirement age are going to be financially secure. So that leaves 95% of people that have worked their entire lives. They've listened to what they thought was the right thing to do. They did everything the right way that their financial advisor, their friends, their family told them to do, or whatever they thought was the right thing to do themselves. But because of whatever reasons, they are not able to retire the way that they want to. And that's why I opened up with, what are your dreams? What are your goals for retirement? Where do you see yourself at that point in life? Where do you see yourself next year? Where do you see yourself in 5 years and 10 years at retirement age? And let's figure out what can stop you from getting there. Let's eliminate that stuff, and let's make sure that it happens. And if you follow these strategies, I guarantee you can be part of the 5% that is able to achieve their hopes and dreams and goals. And the reason I can guarantee is because I see it happen over and over and over again. When somebody has that mindset shift, when somebody starts implementing these little changes into their financial lives, it changes everything. So let me get into that just a little bit more. So why aren't more people successful? Why are 95% of people not able to achieve those goals? And over the years, I found it really boils down to these 6 areas of life. So these top 3 areas right here, I can teach you tonight how to eliminate this from your life and not worry about it anymore. We're going to take advantage of laws in this country where taxes are no longer a wealth killer. One of the main reasons why people are not able to retire when they want to is taxes. Actually, taxes absolutely crush our finances. So we're going to start taking advantage of different places to put our money and take advantage of things like tax-free growth. Inflation, we can eliminate inflation by keeping our money growing and keeping our money moving and making more money. And by making these little tiny things, we're going to eliminate inflation from affecting our finances. Volatility. For example, guaranteed growth, guaranteed tax-free growth. That's what I'm teaching you here tonight. And then taking that money and putting it into investments that provide predictable, consistent income, predictable, consistent growth, where we're not riding these crazy ups and downs of the stock market and crypto investments and things like that, where, hey, you know, the stock market over time always goes up, but what if it's going down at retirement age when we need that money? So we thought we were good. Retirement age is here. We thought we were good. Our money's up here. And then all of a sudden the market takes a dip and all of a sudden our money's dropping below again. And now we're at retirement age and now we need more money. And now we got to work longer or we got to take on more risk. So we can eliminate that stuff by preparing right now and setting ourselves up. And then these other three are just mindset, following the status quo, fear, and life. And you guys know what I mean by that, right? Does anybody like Shark Tank? Do any of you guys ever watch Shark Tank? I still watch it, not as much anymore. I used to love it. I probably watched almost every single episode of Shark Tank that's ever been out. I love Shark Tank. So have you ever been watching Shark Tank or just been walking through the store and you saw a product or you saw an idea or something and you said to yourself, like, holy shit, like I thought of that same idea myself. Like, hey, I came up with that same idea 10 years ago. And now you see it there in front of you and you're thinking to yourself, wow, somebody else is making millions of dollars off of that idea. Has any ever happened to any of you guys before? So it's things like that. Well, okay, you had the idea before they had the idea and made millions of dollars off of it. Why didn't you start it yourself? And a lot of times it boils down to fear. It boils down to not knowing how to do it. You know, what other excuses do you know, why didn't you start it, right? Oh, because I had a job at the time and I continued to follow the status quo, going to my job, making money because that was the safe thing to do. And the risky thing to do would have been quitting and starting this company that launched that product. Right. But then you look back on it, you're like, man, taking the safe route has not gotten me to the point in life that I thought I was going to be at. Taking the safe route is not projecting for me to be able to achieve my financial goals in life. So taking the safe route always typically isn't actually the safe route because it puts you in a position that you don't want to be in anymore financially. So little things like that. So by understanding money, taking the mysteries out of it, by having somebody to help you and support you, by eliminating the crazy ups and downs and having a plan, this is all stuff that can eliminate these problems, these excuses, these reasons why more people are more successful. We're getting those out of your life right now. So we aren't going to look at these excuses anymore. We're getting rid of these. These are just simply roadblocks that we're going to overcome together, and we're going to set you on the path that you want to get to. Is that fair enough? And it all starts with mindset. So here's 3 things real fast to help with mindset. Go to YouTube and type in the backwards bicycle. You guys got to watch this video. It talks about mindset. That's all I'm going to say on it. But go to YouTube after we're done here and type in the backwards bicycle. It's like an 8-minute video and watch it and let me know what you think about it. Also, books. Books are a great way to help start developing your mindset. Between the news, between family, between social media, between the internet, between life, it's full of negativity. What does news stand for? What's the acronym for news? Negative education with society. NEWS, negative education with society. News. That's all news is. It's negative, 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 negative. Social media. What are the stories that are shared? What are the clickbait articles that are wrote? All the headlines everywhere. Negative, 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 negative. Like, it's just crazy. So we want to start eliminating that. So we want to start surrounding ourselves with positive people. That's why, like, the event that we were all at this weekend in Buffalo, that's why masterminds, that's why webinars like we do every single week are so very important. So we can start surrounding ourselves with other like-minded individuals. We can start surrounding ourselves with positivity. Then we start making these little changes, everything changes. So books, audio books, the more the better. So this is a good one right here, Robert Kiyosaki. He talks all about the infinite banking concept in his book, Second Chance. And by the way, if you've never read Rich Dad, Poor Dad or any of Robert Kiyosaki's books, start there. If you want to become an entrepreneur, you want to start thinking like a millionaire. And if you want to start setting yourself on a different track forward, go to Robert Kiyosaki, unbelievable guy. Tony Robbins, another one I highly, highly suggest. He talks all about the infinite banking concept in his book, Money Master the Game. Becoming Your Own Banker, R. Nelson Nash. If you're getting into infinite banking right now and you have not read or listened to this book yet, tonight, go buy this book. You can get it on Amazon. You can go to the moneymultiplier.com. They sell it there. Or go on Audible and it's available there, but go buy that book. Mapping Out the Millionaire Mystery. This is an updated book that Chris and Brent wrote, my two mentors. Chris and Brent wrote this book a few years ago. It's like an updated version of Becoming Your Own Banker. We'll give you that book free of charge. All you got to do is pay shipping for a hard copy of it. And then the Private Money Guide, definitely check that one out. You can get a free copy of this also, just pay shipping. Or if you guys want, would you guys like a free copy of these books tonight? So for being on here right now with me, I'm going to give you a free digital copy of both Mapping Out the Millionaire Mystery and the Private Money Guide. A free digital copy. You guys want those? So all you got to do is you got to go to this website right here. Here, I'll put it in the chat box for you. All right, so go to that website right there, put in your name, email, and phone number, and then it will automatically send you a digital copy of those books. And then I'll also send you the webinar schedule each week, so you can hop on the webinars tomorrow, and I'll send you some other resources also, just as a bonus for being on here right now. So again, my name's Stephen Agee. This is my personal cell phone and my email. If anybody needs to contact me from this point forward, I am now here for you. So I want to become your mentor. I want to become your coach for the infinite banking concept. So when you go to this website and request the free books, you'll also have an opportunity to schedule a call with me. Go ahead and get that call scheduled. My calendar gets booked out sometimes 2 and 3 weeks. So get a call scheduled with me right now on that calendar. I'll teach you infinite banking tonight. And then you can dig into Mapping Out the Millionaire Mystery. You can dig into our trainings tomorrow, and you can dig into some of the pre-recorded trainings that we've done that are on the resources that I'm going to send you, so you can learn more before our phone call. Okay. It's a free call. I'm not going to charge you anything for it. What I decided when it comes to the infinite banking concept, I don't charge anything. Real estate clients, I've charged as much as $10,000 to coach them in the past. I charge nothing to teach the infinite banking concept, so take advantage of it. So again, I've been doing this for a long time, former financial advisor, fully licensed Series 7, Series 66. I no longer have those licenses. So any advice I give you here tonight is not legally financial advice. It's all from experience. I've been doing this for 15 years between financial advising and between the alternative investing space, which is considered real estate investing, private money lending, crypto, notes, apartment complexes, things of that nature. Like I said, I've also owned several companies. My wife and I just bought a new franchise last month, and she retired after 13 years of teaching kids with autism and special needs, specifically autism. She retired this summer, and she is now helping me run one of our franchises, and we are teaching our son all about this as well. So my son is learning all about business. He has his own, what I'm showing you here tonight, the infinite banking concept. He has his own policy. So he's starting to learn this. He's now 6 years old. We live down in South Florida in Jupiter. If anybody's familiar, Northern Palm Beach County. And if you can't tell, I absolutely love what I do. I'm very passionate about it. And those of you that do know me, I think would vouch for me. So a lot of what I teach is going to get into what we call a spread. So whenever we look at money, and I'm going to give you a couple examples of this as we go here tonight, but a lot of what we do when we talk about moving money is we're working off of a spread. Meaning, if you're, let's say you're using money at 4% and you're making 12% on that money, you now have an 8% spread that you're making, right? So we need to start understanding how spreads work. We also need to understand that there's different types of interest and different types of investments that we can make. So let me just ask this question real fast. This is for the new people that are on, okay? Can you make money earning 4% while paying 6%? Yes or no in the chat box. What do you think? Can I make money earning 4% while paying 6%? I just want to make sure you guys understand spread. Yes or no? All right. And then to explain what I mean by this, I'm going to do it with math. So you guys can use a compounding calculator. I've already done the math for you. So let me tell you a quick story. Let's say that you wanted to buy a new car. Let's just say that car was $25,000. And let's say that you've been saving money at Wells Fargo or your local community bank, wherever you do your banking, Chase, whatever. And you want to, you've been saving up in your savings account to buy this car for $25,000. So you go on down to your local bank, Wells Fargo, Chase, whatever, the local branch office. You walk into the bank and you say, "Hi, Mr. Banker behind the counter. I would like to withdraw $25,000 from my savings account." And they say, okay, no problem. Hang on 1 second. And then they go into the back room, and you know what they're already doing, right? They're already going to figure out a way to not have you take that money because they probably don't even have $25,000 cash sitting there. I bought a golf cart not long ago, maybe 2 months ago. It was $8,000. So I went down to my bank, plenty more than 8,000, not lots more. Most of my money's in my policies, but I got plenty more than $8,000 sitting in my local bank account. Okay. And I said, I want to withdraw $8,000. It took me almost an hour to get my money. And I had to argue with them because they told me it was going to take, they don't have $8,000 cash there. And it was going to take them a couple of days to get the money from another office. So after I went in circles with them, they finally gave me the money. But nonetheless, banks don't keep cash sitting there. And I'll talk about that in a second. So you go and the banker says, okay. So then all of a sudden the teller comes back to the counter and they have now a vice president with them, right? This is guys with a suit on and they have a little name badge and it says vice president on it, right? And if you've ever noticed at a bank, everybody is a vice president. And I'll tell you why in a second on that. But nonetheless, so this vice president comes and they say, hey, Steven, you know, I hear that you want to buy a new car and you have $25,000 in your savings account that you're going to use, but let me give you another offer real fast. So here's what I'm going to do for you. I'm going to take your $25,000 and what we're going to do is you're going to keep it in that savings account. And that savings account, I'm now going to give you 4% returns on that money. Okay. So I'm going to give you 4% interest on the money that you have in your savings account. Now it's obviously a magic savings account because no savings accounts right now offer 4%, but for the sake of argument, they're going to offer you 4% in this magic savings account, okay? And they say, what we're going to do is we're going to use your savings account as collateral. And then, so since you have $25,000 in there, we will give you a loan using the account as collateral for $25,000. So that way the money can remain in your account, earning interest, and we'll give you the loan for $25,000 so you can go buy that car that you want. And you think to yourself, okay, well, that sounds pretty cool. I wouldn't mind earning 4% in my savings account. And you say, okay, well, how much are you going to charge me interest on that car loan? And the Mr. Fancy in a suit banker says, well, we're going to charge you the going rate for a car note, which is 6%. And you think to yourself and you say to him, you look at him and you say, I knew it. You bankers are always trying to screw us. Think about what happens when you go to a bank. When you go to the teller at the front counter there, they always have a little bowl of lollipops, right? What is the name on those lollipops in every bank throughout the whole country? Dum-dums. So you grab a lollipop, right? And you say, I know you think we're all dum-dums. That's why you give us these lollipops, but I'm no dum-dum. There is no way I'm going to pay you guys 6% while you're paying me 4%. And the banker says, listen. This is why I'm the banker, because I understand money. Let me get a compound calculator and let me show you exactly what I'm talking about. So here we go. I did the math for you guys. So if we took that $25,000 at 4%, and then we did the loan at 25%, now a car note is usually 5 years, right? 60 months. So you're going to start paying that car note back on a monthly basis. So you're paying $483 a month back for 60 months. Well, at the end of those 5 years, that $25,000 will become $29,000. But look over here. The $25,000 that was sitting in your savings account over the same 60 months or 5 years has now grown to be just over $30,500. So how the heck did we just make $1,500? How did we just make $1,500 earning 4% while paying 6%? How? Well, if we take a compound calculator and we do the math on this, how we were able to do this is because the loan, the car note, was a depreciating loan. So as I made the payments, the balance, the principal balance on that loan went down and down and down. So over time, we were paying 6% on a lower amount. This is what's called simple interest. Over in the savings account that we were earning 4%, that money was compounding each year. So this is what we call compounding interest. So we can actually make more, in this case, $1,500 more, paying 6% while earning 4%, because one, we're paying simple interest depreciating, the other one's compounding always and forever. So a lot of what I'm teaching you here tonight is going to work off of spreads, and it's going to work off of simple versus compounding interest. So keep that in mind right now as we get going here right now. But again, it's just simple math. Now, let me show you what this money multiplier method is. What is the infinite banking concept all about? And before I go there, I just saw a couple comments I wanted to hit on. So first, us anonymous says, my father is retired New York Police Department officer, is pushing toward a civil service route while my father is comfortable with pension and Social Security. However, for our generation, do you see that as a viable option for someone who is 27 thinking long term? Landell, pensions, Social Security, we're $30 trillion in debt right now. Taxes continue to go up. They just came out with this new bill that seems that it's going to pass maybe. And everyone's saying that it's not going to increase taxes. Every single tax institute, every single tax, whatever they're called, that like do the research on these things, the tax research agencies, they all say that this bill is going to increase taxes. So we can't trust politicians. We can't trust the government. So to me, why are we doing things like putting our lives, putting our families' futures in the hands of them? And that's why I'm so passionate about taking back control of your money, because you can, Landell, you can continue to do what you're doing. If they match you, put the money in. If they're offering you something, then go ahead and take it. But I would plan on it not being not there. What is your plan? Start implementing what I'm teaching you here tonight, where you're not doing anything different. You're not taking on any more risk. It's just where your money goes first. So if we can start putting our money into vehicles like this, where we now control it, to me, that makes a lot more sense. And Landell, I'd love to talk to you more about that one-on-one. So hopefully that helped right now, though. And then Bill was asking, when you get a chance, let me know how to join the Private Money Club. I know you were there this weekend. Yeah, absolutely. It's just privatemoneyclub.com. And if you have any questions about it, let me know. So what is the money multiplier method? It consists of three parts. The machine, which is the vehicle that's going to warehouse our wealth that we run the money through. The marathon, because this is not a get rich quick $1 billion lottery ticket. It's a lottery ticket, in my opinion, but it's going to take a little bit of time. So we're not going to get rich overnight. But if you follow the machine and you follow the marathon and the method that we teach you, then you will become the millionaire, because this is guaranteed uninterrupted compounding growth. So let's start with the machine. What is this machine that we speak of? Well, this vehicle is nothing more than a dividend paying whole life insurance policy from a mutually owned life insurance company. That's it. That's where the magic is. It's a whole life insurance policy, guys. But before you jump off and run away because you weren't here to get sold a life insurance policy, don't worry, I'm with you. Okay, let me clarify here. First off, this is not a whole life insurance policy that's off the shelf that you can buy from your brother-in-law, your friend from high school, some family member. I feel like everybody knows somebody that sells insurance, right? This is not that. This is not a life insurance policy that you call the insurance company or you go to policygenius.com and you get from them. This is a specially designed and engineered whole life policy built specifically for banking, period. This is what I do. This is what me and my team do all day, every day. I have a team of people that this is all we do is design policies for our clients for banking purposes. This is all 100% I do is banking policies. So I just want to make that very, very clear. We use dividend paying companies because this is what's going to offer our uninterrupted compounding growth. And we use mutually owned insurance companies because these are the best of the best in the country. These companies that we use have been paying consistent, strong dividends for well over 100 years, and they are the best of the best in the country. We use about 3 to 5 different companies for these policies, depending on the situation. So I just wanted to make that very, very clear. The reason also that we use whole life to do this is it's because it's the only vehicle that allows us to do what we do with it. It gives us uninterrupted, guaranteed, compounding, tax-free growth on our money, while we're simultaneously able to use that money to do everything that we're going to do for banking purposes that I'm going to show you during the rest of this presentation. Things like paying off debt, recapturing that interest, keeping our family lives, and paying off that debt while building wealth faster than otherwise possible. Making purchases like buying cars and recapturing all of the money for those vehicles. Doing things like investing in real estate, doing private money lending, where we have uninterrupted tax-free growth of our money in one hand while we are doing our real estate and private money lending and investing in this hand over here simultaneously. So we're just creating this perpetual tailwind. So the reason we use whole life is because there's no other vehicle in this country that gives us the ability to do all of that with it. And that is all thank you to the United States government and the IRS. They allow us to build these whole life policies to do all this for them. And why do they allow us to do it? It's because it's what they do. It's because it's what the politicians do. It's what the wealthy do. Let me give you an example. This policy, I opened up with this. What I'm teaching you is not new. It might be new for you, but it's been used for over 200 years in this country. So people like Jim Harbaugh. Jim Harbaugh is a college football coach, one of the highest paid football coaches in the country. This was an article from 2016. It says, Jim Harbaugh, this type of deferred compensation alternative appeals to talented leaders and executives. In August, the University of Michigan announced that it amended its contract with head football coach Jim Harbaugh to include a creative deferred compensation alternative involving cash value life insurance. The arrangement makes Harbaugh the highest paid football coach in the country. And he was able to do that through cash value life insurance. How about Joe Biden? Politicians are using this all day, every day. Biden, on top of his checking accounts, he holds 6 life insurance policies with Mass Mutual. Mass Mutual is one of the insurance companies that I mentioned earlier that we do business with. Why does Biden have 6 of these policies? Because these policies are private. You don't have to report them anywhere. You can use money from them without anybody knowing about it. And they're protected from outside creditors, debtors, and bankruptcies in most cases in most states. So if Biden's doing it, why wouldn't we? How about Walt Disney? You guys know Walt Disney World? Disney started Disneyland borrowing from his collaterally borrowing money from his cash value life insurance policies. Who else? Doris Christopher, the Pampered Chef. She borrowed money from one of her whole life policies to start the Pampered Chef when was this? In 1980, in her home in Chicago. She later sold that to Warren Buffett for $1.5 billion. Ray Kroc. He also used whole life insurance. He borrowed money from 2 of his policies to help cover salaries for key employees when he was starting out and he didn't have money to keep McDonald's going. As well as people like the JPs, the Morgans, the Chases, the Vanderbilts, the Rockefellers, the list goes on and on. So these are all people throughout history that have and are currently using this exact same concept to build wealth for them and their families. So I mentioned before about spread. Let me show you specifically how banks work, because one of the other things that we're going to do is we're going to start mimicking not only what the wealthy people do, but also what the banks do. Do banks know how to make money? Absolutely, right? So the way a bank works is you take money, you deposit it at the bank in your savings account, your checking account, whatever. The bank then takes that money and they don't leave it sitting there. They take that money and they start to move it. They start to lend it out themselves. So you take $100,000, you sit at the bank. Then you need a home loan. You go to that bank to give you a mortgage. So they're paying you 4% in your savings account. They're now making 7% off that home note. Again, these spreads might be a little bit off. Maybe you're making 1% in a savings account and you can get a home loan for 5% now. So it's still a 4% spread, but whatever it is, I'm just giving you an example here. So then the seller you take that money, you give it to the seller. What's the seller do? They put it right back in the bank. And this just goes round and round. Same thing with buying cars. Same thing with a home remodel loan. Same thing with a debt consolidation loan. The money just keeps on moving. So the bank's been paying us 4% this entire time. So let's do the math. What did the bank just make off of our $100,000? They're paying us 4%. What did they just make? Well, they made 3% off that loan. They made 4% off that loan spread. 5% off that spread. 8% off that spread. So the bank just paid us 4% and they just made a total of 20% off of our money. So in reality, we put $100,000 into the account. We made 4% interest on that money. They made 20% interest on that money, meaning they made over 500%. Think about it. 20% is 5 times more than the 4% they're paying us. They made 500% returns off of the money that we left sitting at that bank? Think about that for a second. Why are you putting your money at the bank? Why do you go down there and deposit your money at the bank? Why are you letting the bank make 500% returns off of your money? And don't take my word for this stuff, guys. Go to Bauer Financial. Here's more homework for you when you get off here. Go to BauerFinancial.com and start playing around on there. BauerFinancial.com is a research company, and all they do is they hold banks accountable. So they research banks, they release, what the banks are doing and stuff like that. And they say banks make between 400 and 1,300% off of the money that you leave there. So why are you leaving money at their bank? Why aren't you making 400 to 1,300% returns off of the money that is sitting there warehoused in an account? Well, probably because nobody's ever taught you how to do this before, right? Because if you owned a restaurant and you had people in town, where would you take them to go eat? Or if you owned a hair salon, where would you go get your hair cut? Right? At your restaurant or at your hair salon. Well, if you owned your own bank, where would you go to deposit your money? In your own bank, right? Absolutely. So why haven't you done this before? And again, it's maybe just nobody's introduced you to it before. Maybe it didn't make sense to you before. Maybe you didn't have somebody like me and my team that would help you do it. So that's why we're here, guys. So we can start taking back control of this money and making these returns, keeping this money within our financial lives instead of giving it to everybody else. Let me give you one more example of how we're giving away money to everybody else. So this is annually how people spend money in this country. If we take a dollar bill, 20 cents of every dollar that you make goes towards an automobile, whether it's payments, gas, upkeep, whatever it is. 30 cents of every dollar you make goes to housing, whether that's a mortgage, insurance, taxes, upkeep again, whatever the case might be, which leaves you with 40 cents of every dollar that you make goes to everything else. So that can be food, travel, kids, education, entertainment, whatever the case might be. So that leaves most people with, after all that money goes to everybody else, that leaves most people with 10 cents of every dollar that they earn goes to savings. Okay. First off, that's backwards, because we should care about ourselves before we care about everybody else. So we should be saving first, right? But so let's build this thing backwards. What would that look like if we did that and it kept all the money that we're giving to everybody else? What would that look like? So first off, let's start paying ourselves first. So of that dollar that we make, 10 cents first is going to go into our savings account. All right. And then let's look at that automobile. So that automobile right now, on average, 5 cents of every 20 cents that goes towards an automobile goes towards interest. So instead of giving that interest to the bank, to Ally Financial, to Chase, to BMW, to Toyota, to whatever, let's take that 5 cents that we're right now giving to them and let's pay that back to ourselves. Are you okay with that? So instead of giving that interest to someone else's bank, let's go ahead and take that 5 cents we're already giving to them and just give it back to us instead. And then let's take housing. Did you know of out of the 30 cents of every dollar on housing, 25 of that 30 cents goes towards interest? Why is that? Why is 25 cents of every 30 cents goes towards interest? Well, there's two reasons. Number one, on average in this country, every 7 years, a homeowner is either going to move or refinance their house. Well, when you refinance, you're refinancing into a new mortgage. And when you move, there's a due on sale clause, meaning when you sell, that mortgage ends, that note ends, and you have to start a new one with your new house. Did you know on average in this country, on a 30-year fixed note, over 90% of the interest is paid in the first 7 years? So if over 90% of that interest is being paid in the first 7 years, and people are either refinancing or moving on average every 7 years, do you see why the banks do that? The banks are getting all of that interest up front, so they don't care anymore. So that 25 of every 30 cents that's right now going to other people's banks, we're going to recapture that back into our bank. Are you okay with that? And then of the 40 cents that's spent on everything else, of that, about 5 cents goes towards interest. So while we're at it, why not recapture that money as well? So right here, we didn't do anything different. We didn't work any harder. We didn't take on any more risk. We did not work any longer. All we did is changed where that money was going. Instead of into somebody else's bank and all that money going to someone else's bank to make them rich, we're taking that money and we're putting it into our bank. Think of your bank as your new savings account on steroids. So we're taking that and we're putting that in our bank. So instead of just saving 10 cents, we now are able to save 40, 45% of every dollar that we make by doing nothing different. Are you guys okay with that? Everybody okay with that so far? So let me show you how we can start doing this. Let me just check the chat real fast. So Todd was asking, Siggy, is there a max policy size for one's first policy? Nope, just what you can qualify for, Todd. 5 words, tax-free, uninterrupted compound interest. Absolutely. Are these vehicles regulated? Yes, the insurance industry is highly, highly, highly regulated. I am fully licensed and do ongoing compliance training in all 50 states, actually, plus DC and Puerto Rico, to be able to do these policies. And then Scott said, how could you pay the mortgage? Yes, Scott, I'll show you that right now. Okay. So how to get all the money back for every car you'll ever buy, drive, and own. Here we go. So let's talk about the machine. So before I show you that, let's take a look under the hood of this life insurance policy. So over on the right side is what we call an illustration. And the illustration comes with every single policy, and it shows you all the pertinent details of the numbers. So the policy year, the age that the person is. So in this case, this was a 26-year-old that started this policy. Now you'll see this right here, deposits. So the deposits are actually the premiums of the policy. So when you first start one of these policies, you're going to tell us how much you want to pay into it, how much premiums you want to put into this policy on an annual basis. And then you could pay into it monthly, quarterly, biannually, or all upfront each year, but we'll build it around this annual number. So in this case, this 26-year-old wanted to put $10,000 a year into their policy, okay? And from this point forward, I want you to start thinking of these premiums as deposits. Why? Because of mindset. Because if I tell you you have a car payment due or a premium due on some kind of thing that you own, you know, when you have a payment or a premium, you're like, I don't want to do that. You think of it as a negative, right? But if you have a paycheck or you just did a wholesale deal in real estate and you made $10,000, or you did a flip and you made $80,000, you know, and you have that check sitting there, you have that cash sitting there, and you want to go down to your local bank and deposit it into your business account and you're in your savings account. Well, when you do that, you're excited, right? You're ready to run out the door and you're ready to go down to the bank and deposit that. So if we're creating our own bank and we're going to deposit that money into our own bank, well, would you consider that as a negative premium or a positive deposit? Positive deposit, right? So we're changing our mindset right now. So from this point forward, all of the money that goes into that policy through premiums, those are now deposits into your new bank. Fair enough? And then, of course, over on the right side over there's the death benefit. So this entire banking policy does have a death benefit associated with it also, because it is life insurance. So age doesn't matter, whether you're 26, whether you're 6 months old, whether you're 70, or even if you're older, it doesn't matter. Because even if you're 90 years old and you can't qualify for your own policy, you can still do banking. Even if you're 5 years old and you can't legally sign your own policy, you can still do banking, because somebody else can be the life on your policy for you. So if you're 80 years old, maybe you have a child or a grandchild that you can use their life, and then you can still own the policy, control the policy, put the money in, take the money out, use it for banking. It'll just be on somebody else's life. So the age does not matter. And the death benefit, while it is there, it is tax-free. It is a beautiful thing. It's not why we do this. We do this for the banking part of this setup, okay? So just wanted to kind of give you a quick look under the hood of what one of these illustrations of one of these policies looks like. And then I skipped over this, the cash value. So the cash value is the bucket that is available to pull the money out as it goes in. So as you put the deposits in, the cash value grows. As those deposits compound uninterrupted, that cash value grows for the rest of your life, guaranteed. All right, so let me show you how to get all the money back for every car you'll ever buy driving home. So this 26-year-old started this policy, putting $10,000 a year in. And in the third year of this policy, he wanted to buy a car for $25,000. So he goes and he takes the money from his policy, $25,000. You'll see the cash value dropped when he took the money out of the policy. Now, if you were going to, Tammy, you can start borrowing from the policy immediately. We typically say within 30 days just to be safe. So if you were to take a loan from a traditional bank, from Ally Financial, from Toyota, BMW, whatever, you're going to repay that loan, right? Well, if you take a loan from your own bank, is it fair to say that you're going to repay that loan also? Absolutely, right? So this is what you see right here. We take the $25,000 out, and then we're going to start paying ourselves back that money. So instead of paying back the other bank, we're going to pay ourselves back just the same way. So on a $25,000 loan over 5 years, you're looking at about a $500 a month repayment, or $6,000 a year. So we've now put $70,000 into this policy. We took $25,000 out of this policy, and we recaptured another $30,000 back into it. So a total of $75,000 we put into it. We now have a car sitting in our driveway, free and clear, paid for, and we have $67,000 in our account. Okay, not 25 less, not 50, but 67,000. So when I do the math on that, I've now recaptured 91% of all of the money that I used to buy that car. So not bad. If I was to do this the other way, that's $6,000, that $500 a month, $6,000 a year would now be at Ally Financial. And none of this would be here for me, but I've recaptured 91%. I told you I'd show you how to get all the money back though. And here's where this goes, because this doesn't stop now. This money is going to continue to compound and grow forever, for the rest of your life. So let me show you how this keeps going. All right. So for the sake of argument, and for this example, we're not going to put any more money into this policy after the 7th year. Now, in reality, your policy, you're going to continue to put money into it, whatever amount you decide for the first 10 years. And then in the 11th year, that amount's going to drop, and then a smaller amount's going to continue to go in. We can always convert the policy after the 10 year where you stop putting money in. There's lots of different things that we can do. Ask me about that on our phone call if you want to talk about it. But just for the sake of argument here, for this example, we're going to stop putting money in. However, in the 8th year of this thing, we buy another car, $25,000, and then we're going to recapture the money again. So we put no new money into it, $30,000 recaptured, $25,000 to buy that car. So check it out. We put no new money into this thing. We recaptured $5,000. Our account grew from $67,000 up to $91,000. We put no new money into it. So how did I get that growth? Through the uninterrupted compounding interest of this money right here, right? And check this out. I now have $91,000 sitting in my account, and I bought 2 cars for $50,000 that are now sitting in my driveway, free and clear, paid for. So I have $91,000. I bought $50,000 worth of vehicles. I would say I've now recaptured all of the money that I spent to buy these cars in the first place. And I'm ready to go with $91,000 for my next purchase. Now, there's a few things that need to be done for this to work. So there's 3 rules in infinite banking that I want to teach you. Rule number 1, pay yourself first. I mentioned that earlier. Rule number 2, pay yourself with interest. If you were going to pay the bank interest, you damn well better pay yourself interest too. Why would you shortchange yourself? You're the bank. Don't shortchange yourself. And you always want to recycle and recapture your money also. So those loans that I was showing you, they don't have to be paid back. Okay. If something goes wrong and financially you can't pay that loan back, well, unlike a traditional car loan where they're going to come repossess your car and the tow truck driver is going to hook it up and tow it away, you might cut yourself a break. You don't have to repay those loans, but for infinite banking to do this over and over and over again, you're definitely always going to want to start recycling and recapturing that money so you can do it time and time and time again. And if this works for a car, what else can it work for? Rehabs on properties. Maybe work on your own house, a remodel loan, home remodel loan. Maybe buying an airplane, buying a boat. What other major purchases in life do you have? So we can use this concept for basically anything. And we'll show you exactly how to do that. But let's talk about debts for just a second. And Tammy was asking, what is the average rate of return? Well, the money's going to compound at 5 to 6% is what the dividends are right now. That are being paid out. Those should go up over time as we get out of this zero interest rate environment. But nonetheless, that's what the dividends are that the policy is compounding through. And then whatever you're using that money for to recapture, recycle, keep that money moving, that's all going to play into it as well for what your actual returns end up being. And I'll show you an example of that, Tammy, in just a second. Okay. But before we get there, let's talk about debts for just a second, because a lot of people, end up racking up some debts, even if you're making good money. A lot of times there's a lot of third-party debt out there and money we're giving to other people that we don't even realize. So let me give you an example here. So this was a chiropractor. This was an actual client, 45 years old. He had nine third-party debts, totaling $478,000. And he was paying $5,777 a month in third-party debt to these people. And a total of almost $70,000 a year was going out. So we did the math for him. It was going to take him 19 years to pay back this $478,000 following this plan right here. So we said, all right, let's show you what infinite banking can do for you while continuing to build wealth. So check this out. So this chiropractor decided that he wanted to start a policy putting $25,000 a year into it. Again, you decide how much you want to put in this policy. As a guideline minimum, I will tell you that you should start with 10 times your age on a monthly basis. So I'm 39, so $390 a month, $400 a month going in. That's a good first policy as a guideline minimum. So that amount, if you're 52 years old, $520 a month. So that amount or more is a good guideline minimum for your first policy. But this chiropractor wanted to do $25,000 a year. So he puts $25,000 in. He now has cash value available to take back out of almost $15,000. So you'll see that it takes a few years for the policy to become efficient. And I'll show you that in just a second. But once that happens, every dollar you put into that policy from that point forward, now you start taking more than a dollar back out of it every year for the rest of your life. But it does take a couple of years, so I'll show it to you. Now, the policies we build today, we can get you much higher cash value quicker on. Like if you're a real estate investor, you need that money right now. We can get that way up there, 90% in some cases. So I can show you how to do that also. But nonetheless, we always under promise and over deliver. So if this works with this policy, of course it'll work with a higher cash one. Let me show you. So we take that $15,000 out and we immediately use it to pay off the Lowe's card, pay off the Discover card, and pay down the Nordstrom card. All right. So by doing that, we eliminated $448 a month that was going to them. So you'll see that down here. Now, we have $5,300 a month going to third-party debtors and $448 a month that we stopped giving to them. But what are we going to do with that $448 a month now? We're not paying it to Discover and Lowe's. So who are we going to pay it to? Yeah, Todd, recapture. Absolutely. So I mentioned before, recycle and recapture. This is how you're going to start recapturing the money back into your financial life. So instead of that $448 a month going to Discover and Lowe's, that $448 a month is now going to go back into our bank. Okay. So one of the things that we're going to teach you how to do is set up what's called a segregated or separate bank account. So when you take money out of the policy, it's going to go into that segregated or separate checking account. And then from there, it's immediately going to go to pay off this debt or to purchase a car or to invest. And then from there, we're going to recapture this $448 a month back into that segregated account. And then that 448 a month is going to grow within that segregated account. And you're going to see in just a second how in the second year, we're now going to take that money from the segregated account and we're going to pay off more debt with it. Okay. So you'll see that in just a second. So just wanted to clarify, this is the recapture of the money. That 448 a month is now going to go back into our segregated account, essentially our bank system. Year 2 of the policy, 25,000 goes in, 16,000 is now available. Again, I told you every year, more and more cash value as the money goes in is going to be available because of compounding. The 5,374 in payments that we recaptured, that's that 448 a month over the year. So now we have the 16,000 in the policy we can take out. We have the 5,000 in the segregated account that we recaptured for a total of 22,000. We take that, pay off Nordstrom, pay off Wells Fargo, pay off the private loan, pay down the BMW. We now have 1,900 a month going back to us and 3,800 a month going to BMW, West Marine, the condo, and the house. Third year of the policy. Same thing. Pay off the Beamer, pay off the West Marine, pay down the condo. 3,600 going back to us, 2,100 going to third-party debtors. All right, now let me make sure that you guys are following so far. Here's a quick quiz, real quick. How much do we put in so far? $75,000. How much do we take out so far? $55,000. So how much is left in the policy? We put 75 in. We took 55 out. How much is left? It's not 20,000. It's $75,000. Follow me. As we put money in this policy, when we take the money out of it, we're not withdrawing our money. We're taking a loan against the policy. What the insurance company is doing is they're saying, we will give you a loan from our fund's general account, and we will use your policy as collateral for that loan. So therefore, if you never repay that loan, we don't care because we're just going to take it out of the death benefit before the death benefit gets paid out. So the insurance company doesn't care if you pay back those loans or not. But this is what allows, these loans are what allow the money to come out, A, tax-free, B, unreported, and C, allow all the money to remain within the policy, compounding and growing uninterrupted for the rest of your life, even while simultaneously taking the money out and using it. All right. So just wanted to drive that point home real fast. Let's keep rolling. Year 4 of the policy, 25 goes in, same thing. Year 5 of the policy, same thing. Now, check out what happens in year 6 of this. Year 6 of the policy, his first policy, the chiropractor that he's putting $25,000 a year in, would now only allow him to put $10,000 a year in. Remember, I told you a second ago, after the 10th year of our new policies, in the 11th year, that amount is going to drop off. If you were doing 25, it might drop down to 8, might drop down to 10, whatever. This one dropped from 25 to 10, meaning that's the most they can put into that policy. But you can have as many policies on yourself as you want. So what this chiropractor did is he said, okay, I can only put 10 into this policy, but I want to put more into it because I love the way this works and I want to grow my banking system. So what they did is this chiropractor started a second policy. So now they put 10,000 in the first policy with 13,000 available to pull right back out. They put 25,000 in the new policy, the second policy. They now have 15,000 they can pull back out, plus the recapture payments for a total cash of $82,000. We now take that money. We pay off the house. We now owe nobody, no third-party debtors any money. And we have $5,700 a month that we were giving to everybody else that now is going back into our bank. And we'll continue to recapture that money and cycle it back into the policy, and so we can use it over and over and over again. You have debt and you're looking to pay off that debt and create that plan that I just showed you, we will do this for you. So we have what's called our mapping team, and our mapping team is free of charge. We don't, by the way, guys, we don't charge for any of this stuff. That phone call, setting this up, helping you get approved, paying off debt, creating this map, ongoing support, strategy. We don't charge for any of it. So we will literally create this plan for you, just like you just saw. It's called a debt map. Whatever you want to use the policy for, our mapping team will map it out for you and create that plan. I like to call it a financial GPS. Where are we now? What do we have going on in the meantime? And where do we want to go? Let's create that plan. So allow us to do that for you. And if you want to talk about becoming a millionaire, what if you don't have any bad debt? What if you don't need to buy a new car? Should you still do this? Should you still become your own bank? And the answer is hell yes. That's where the fun begins. This is where you can really start growing your wealth, building wealth. And the way that we do this is through moving money. The ways I personally move money through real estate, flips, wholesaling, rentals, short-term, Airbnbs, commercial properties. I do a lot of lending to apartment complexes, mobile home parks, commercial deals, private funds. Private funds are unbelievable. We have a few private funds right now in the Private Money Club that are awesome. Business, as I mentioned, I've owned several businesses. I bought and sold them over the years. We just bought a new franchise last month. I don't do as much with stocks and options, but if I see an opportunity where I can do a short, I'll short sell the market all day long. I'll buy some puts on something. Notes. Kevin Shortell is my mentor for notes. If you guys want to learn buying and selling mortgages, notes, let me connect you with Kevin. He's unbelievable. And then crypto, I'm not as big into that right now. I have a couple guys. Horace is teaching me a little bit right now about some crypto funds that are making really good returns. You know, I talked to Spencer Montgomery over the weekend, who's my crypto expert. So right now I'm just kind of letting it hold. But I've learned a lot about crypto. I'm moving it into hard, cold wallets where if one of the exchanges or something goes down or something happens, my crypto is still protected. So, but anyways, these are all different ways that we can create wealth. And these are all ways that we can take the money from our policy and keep our money moving to make more money. Okay. It's all about keeping money moving. In fact, there's two laws. Number one, take advantage of uninterrupted compounding interest. Those who understand it, use it. Those who don't, pay it. Do you want to keep paying it to the banks, paying it to everybody else? Or do you want to start using it yourself and building it for your family? Number two, like I said before, money sitting still is losing, money in motion is making more money. So let me give you a couple examples. So here's another one of those illustrations. And guys, once I go through the investing side of this, I'm going to answer your questions. So put those in the Q&A box. I don't want to miss any of them, okay? All right, so here's another illustration. So this was a policy that I built for someone, I don't know, maybe 6 months or a year ago. This was with Lafayette Life Insurance Company, 41-year-old female. Now check this out, the contract premium, the deposits. She had a lump sum of money from a real estate deal. So her and her husband on this policy, they wanted to commit to $50,000 a year, but they had more money sitting there the first year. So one of the things we can do is what's called a dump in. So we can dump in a larger sum of money the first year on this thing, and then something more manageable annually moving forward. So check this out. The first year they put $150,000 in, and then they put $50,000 a year. And after that, through the 10th year, and then look in the 11th year, how that drops down, like I said before. So a bigger amount the first year, whatever amount you want from that point forward. And then in the 11th year, that thing drops down. But look what happens. The first year, they have 132,000 of that 150 available to move. And they're real estate investors, so they're buying more real estate with this. I mean, look at this. In the 11th year of this policy, they put $17,000 in. The policy grows by over $45,000, tax-free. And they're not doing anything here. It's just instead of depositing this money into a traditional bank, they're depositing it into their bank account. And I'll come back to this in just a second. Here's another policy, 50,000 dump in, and then $500 a month. So they were 39 years old, 38 years old, and they wanted to do $500 a month. That's perfectly fine. But they had $50,000 sitting there in a savings account, not doing anything for them. Maybe it was a HELOC. Maybe it was a refinance, but that money was sitting there doing nothing. So they dumped a large amount in. They were comfortable doing saving $500 a month. The first year they had $51,000 available. And look at these returns as this thing grows and compounds. I mean, when they're 62 years old, they're getting 281% cash on cash returns on their money that year. It's nuts. So here's a quick little example of how money flows. So we have our policy. This is our bank. This is the insurance policy. We take a loan from the insurance policy. When you take a loan from the policy, the insurance company is going to charge you typically 3 to 5%, really 4 to 5%. The money, like I said before, it's going to go into that segregated account. From there, you move the money. In this case, we did a 12% loan to somebody in the private money club. That loan in the private money club is providing monthly interest payments. So those monthly interest payments now go back into the segregated account. We pay the insurance company back the 4% loan that we borrowed. And then that spread, if I'm borrowing at 4 and I'm making 12, I have an 8% spread. That spread now goes to me as profit. Okay. So this is a simple way the money flows when doing private money lending and how we keep the spread. And then the money goes back in. We just do it over and over and over again. Keep that money moving. Here's an example. In the 8th year of this policy, this policy grew by $66,000. To get that $66,000, they had to inject $48,000 into the policy. So if we do the math on that, if I put $48,000 in and it grows by $66,000, that's a 37% return on my money, tax-free. I then take that money and I lend it out on a private money deal at, let's say, 12%. So now I make 12% on the private money deal. I make 37% within my bank. I paid 5% on this specific policy for that interest to borrow the money. So at the end of the day, if I add it up, I made a 44% return on my money that year. Think about the difference. If I was to take that same money and lend it on that same private money deal, I made 12%. So that money was somewhere, whether it was under my mattress, whether it was at a traditional bank in a business account or savings account, or whether it's in my bank. The money has to be somewhere. So let me ask you, what would you rather make, 12% or 44%? We did nothing different except where that money went first. We didn't work any harder. We didn't work any longer. We didn't take on any more risk. It's the same loan. All we did is where our money went first. We put it in our bank instead of somebody else's bank. And if this makes sense to you, this is what becoming your own bank, becoming your own banker is all about. And by the way, the death benefit is tax-free also. So we're going to start creating this legacy for our loved ones. The loans never have to be repaid. So when you take money out of the policy, how, when, or even if you repay those loans are completely up to you. The internal values grow tax-free, 100% tax-free. And we can create, by lending money to our businesses, different ways that we use the money from the policies. We can actually start creating tax deductions. We can actually start lowering our tax bill as well. So all kinds of strategies right there that I don't really have time to get into right now, but are very, very powerful. These policies are exempt from judgments and liens in most states, and they're very, very private as well. And in kids' policies, if you have children, you have to start one of these policies for them as well. Chris started one for his daughter when she was 6 months old. I started the same policy for my son last year when he was 5 years old. And I start them for our friends, our clients all the time, kids policies, because of time. Compounding interest works off of time. Kids have, hopefully, God willing, a lot of time. So kids policies are awesome. So when they start getting to driving age, when they go to college, maybe they want to start their own business. These are all things that we can use their policy for, to not only provide them, set them on the right foot financially moving forward, because I can give that policy to them anytime I want or never at all. But not only can I set them up financially, but I can also start teaching them how this works. I can teach them to become their own banker. I can teach them how to take loans from themselves and keep that money within their financial lives instead of giving it to everybody else. So I don't want you guys to think of these anymore as excuses. We're just going to start doing what the wealthy do. We're going to do what the banks do. It's time. So Warren Buffett says it best. If poor people would just do what rich people do, they wouldn't be poor anymore. Warren Buffett's got such an easy way of saying things, right? Only one of two things will happen to us while we're alive. Are we better off with or without one of these policies? Once we die, are our loved ones better off with or without one of these policies? And if you can answer yes to both of those, and this made sense to you, this resonated with you, Maybe you have some questions. Maybe you want to talk about your personal situation. Maybe you want to get one of these things started for yourself, for your family. What you'll want to do is schedule a call with me. So go to that website right there. I'll put it in the chat box one more time. Not only will you get the free bonuses, the digital books, you'll also get my call calendar so you can schedule a call. Now, that's also my cell phone number right there. So you might want to jot that down. If you want to talk sooner, if you want to talk outside of what's available on my calendar, shoot me a text message. Tell me, hey, Stephen, I'd love to talk with you sooner. Or, hey, Stephen, I need to talk in the early morning. I need to talk in the evening, something like that. Shoot me a text message and I'll make it happen. And then moving forward, once you become a client of mine, anything you need, I am here for you. This is what I do all day, every day. I've been in this space for 15 years. I'll be in it for the rest of my life. So I look forward to working with every single one of you. So if this makes sense, I do look forward to talking with you guys. All right. So that's all I have for you. So I'm going to answer any questions that you have right now, and then we are going to wrap for the night. So Lynn has, let's see, I have money going to 2 policies each month, still working on paying off debt, then putting money in my recapture account as per my mapping agent or as per my map. So I'm still confused if that is paying myself with interest, even though it is not going back to the policy yet. Yeah. So Lynn, your policies, multiple policies, along with your segregated bank account, make up your banking system. So all that money you're recapturing back into the segregated account will eventually go back into those policies. But right now it's in that segregated account, and that's what's built your whole banking system. So absolutely great question, Lynn. And absolutely that is part of your bank, and you are recapturing that money into your financial life now. So congratulations on that. I know you've been coming on these webinars and trainings for quite some time now. So it's awesome to see you actually doing it and taking advantage of it and recapturing that money. Adrian says, how could I fund my kids' college tuition? So you put the money in the policy, let it compound and grow. Use it in the meantime if you need to. And once they get to college age, you're going to start, we'll map out a plan to use the money for college and then recapture that money instead of giving student loan debt and interest to the government or to, all these different banks and everybody that does student loans. Now you're going to be able to recapture that into you and your kids' financial lives for forever, plain and simple. That's all I see on the Q&A. Any other questions? Scott said, so if we sign up, I guess we also join the private money club. Yeah, well, they're separate things, Scott. So if you're interested in private money lending or borrowing, the private money club is the place to be. If you want to get started with banking, there's no charge or anything for that. Just schedule a call with me and I'll help you get started with it. So with that being said, guys, I hope you have a great night. I hope you have a great evening. If you can do anything at all, if you need any help whatsoever, please let me know. I'm here for you. And I do look forward to talking with each of you on the phone and helping you get started banking. Have a great night. Thank you.